Over the last few days, the US stock market went down. There's a sell-off in the stock market, followed by Asian countries as well. Their stock market also went down with a great sell down. Why is this happening? There are many reasons, but one of the reasons is because investors saw a sign of recession.
The world will end next week! Spend your children's college fund!
What is this sign that they are talking about? It is the inverse yield curve. So, what is this inverse yield curve and how on earth it can tell a recession is coming? To help you to understand this better, let me give you an illustration. Today you have some money and you want to save it in FD, so you go to a bank. And when you go to the bank, you look at the rates. And what you notice is the 2 years FD is giving you 4% return, but the 10 years FD is giving you 3%. Wait. Usually when you go to a bank, when you look at FD, the longer term one should give you a higher return, but the shorter term should give you a lower return because the longer term requires you to commit your money longer, so bank will compensate you more for putting your money longer, right? But now when you look at the rates, it seems that the shorter term one is giving you better return and the longer term one is giving you lesser return. It doesn't make sense at all. And what more, suddenly, when you look at the queue, you realize that everyone is queuing up for the 10 years lower return FD. Isn't it supposed to be a good deal that 2 years get higher return, so I should jump on the 2 years? How come everyone is lining up for the 10 years deal that has a lower return? Why are they willing to settle for a longer term lock-in and lower interest rate? The only reason that this can be happening is because investors think that the future is going to be worse than now. That is why they are willing to settle for a lower interest rate but a guaranteed return over a longer period of time. So imagine this, going back to the earlier illustration, if you go to the bank and you are considering between the 2 years deal or the 10 years deal, 2 years give you 4%, 10 years give you 3%. While you want to take the 2 years deal, you're also very afraid that the future will not look good. You're afraid that later when you need to renew your FD, the new rates that come up will be only 0.1%. If that's the case, you earn that first 2 years of 4%, but when you want to renew it, the new rate is only 0.1%. Then it would be much better for you now to go for the 10 years FD with 3% every year. Although the interest is lower, but it's guaranteed and it's for long term. So that is what investors are thinking. This is actually what an inverse yield is, and this is actually what's happening. Why will this lead to a recession and why will this lead to further sell down? When companies and people think that a recession is coming, they will work towards preparing for it. So this will become a cycle in itself where they cut their spending, where they have retrenchment, where they have cutting of budget. And one leads to another. By now you should realize that the market is a lot more psychological than it is scientific. And yes, that's why it's called behavioral economics. The economy can be very psychologically driven. And this is what I mean by noise. When we say cut off the noise, cut off the noise. It is all these sensational market sentiments that builds up the noise that distract people from looking at the facts and clouds people's judgment. So how should we view this inverse yield curve incident? Should you see it as a definite sign that recession is coming? Or what should you do? For me, it's very simple. When you look at this, you should see it like looking at the weather. When the clouds are low and heavy, it could mean that there's a rain that can be coming soon. But is it definitely going to rain? We are not sure, and that's how you should view it. How can you respond to this? How should you invest your money in these kind of times? So much of volatility and recession may be coming. What should you do? The first thing you need to do is take care of your income. Because during recession, there's a very high possibility for retrenchment and company will cut off people that they do not need or is not important to the operation of the company. And you do not want to be that person that they will want to let go. So take this time to invest in yourself and make yourself valuable in the company. Make your role significant enough that they will not want to let you go even if there's a retrenchment. Secondly, do not time the market. Some of you may be thinking, maybe it's the best time that I leave the market right now, or maybe I should wait for the market to become better, only I enter. The thing is, don't time the market. It is impossible to time the market. And the truth is, if you spend too much time timing the market, you will not be a very happy person. You will spend a lot of time worrying whether you have done it correctly, you have timed it correctly or not, and you lose sleep over it. So no point, don't do that. The best thing you can do right now is do a portfolio realignment. If you haven't realigned your portfolio, do it now. Go and take a risk assessment, understand your own risk tolerance, and do a portfolio realignment. Spread your assets across different different asset class. And one of the easiest way to invest now is actually to use the dollar cost averaging method, where you invest consistently over a period of time. So you can spread out risk in your investment and not lose sleep over it. So it becomes like a system that you invest consistently and build your wealth systematically, rather than spending your time and losing sleep over timing the market, speculating the market. In my opinion, that's one of the best ways to build your core assets. And thirdly, be excited. Look out for investment opportunity. Know this, that if you invested in the right financial assets during the financial crisis of 1997, today you will be very, very rich. Take a look at it. If you were to invest in Nestle during the year of 1997, it would cost only 15 ringgit per unit. And if you invested in 100 units, it would be 1,500 ringgit. Today, even when the market is down, Nestle is 147 ringgit per unit. That means the 100 units that you bought in 1997 will be 14,700 ringgit at a market downturn. Or if you bought a landed property in Bursa in the year of 1997, today that property would worth millions. Always remember, in every economic crisis, there's always opportunity. For the uneducated eye, it is called a financial crisis. For an educated eye, it is called a financial opportunity. So what are some of the assets that you can pay attention to? Do not totally stay away from the equity market, the stock market. Do not totally stay away from the stock market. There are still opportunities. For example, when it comes to core industry, what are core industry? Such as food industry, as usual, Nestle. Will you drink less Nescafe simply because it's an economic downturn? Will you eat less Maggi mee because of economic downturn? You will still need to eat. Healthcare. Will you not see a doctor if there's an economic downturn? If you have a heart attack, you need to do a surgery, and now the economy is down, you will still need to do your surgery. And electricity. You won't be cutting off your TNB when the economy is down, right? You still need electric. You still need telecommunications. So these are the core industries that you should pay attention to. Real estate, one of my favorite, is the area that you should also take a look at. When people can't afford to pay their mortgages, that is when people will want to sell off their mortgages at an under market value. And usually in a financial crisis, this is the best time to buy properties. Imagine if you bought a condominium in Bursa in the year of 1997, or you bought a landed property in Bursa in the year of 1997. It would be worth millions of dollars today. So there are always good buys around as long as you can afford to during that time. Precious metal such as gold and silver, these are things to take a look at as well during a recession or financial volatility. Very often when the stock market drops, people will want to run to safer investment such as gold. So there are a lot of opportunities out there. You just need to keep your eye open. Lastly, the best investment that you can make at this time is to invest in yourself. Because if you want to look for financial opportunities, you need to be financially educated. You gotta understand how the economy works. Then you are able to sniff out opportunity. Why do you think Warren Buffett can invest so well? Because he has knowledge and he knows how to execute his knowledge. Take this time to educate yourself. Invest in yourself. Invest in your education. Invest in your career. Invest in your skill set. Invest in improving yourself. Why? Because during these times, usually retrenchment will happen and you want to make sure that you are important enough for your company that they will not fire you. And during this time, you still have the bargaining chips to earn a living and still invest. And also pick up new skills during this time so that when the market recovers and they're willing to pay to expand their business, your skill will come in handy and you can demand for a price for it. And that's how you ride on a recession and a volatile time and emerge as a winner. So that's all about it for today's episode. I hope you enjoyed it. And if this is the first time you're here, do subscribe to my channel and give me a like.